Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on the 11th day of June, 2019. And I do want to thank each of you for listening to the show, making it one of the more popular shows on the Voice America Business Channel, and also like to encourage you to keep sending along your comments to questionsfortaylor@gmail.com, questions, the number for Taylor@gmail.com. We also want to thank our sponsors for making this show economically viable. Today's sponsors are Novo Resources, RN Resources, and Strike Point Gold. Before we get started with today's show, I want to suggest to those of you who might not have heard Richard Maybury's comments last week regarding the topic of whether modern monetary theory will ignite the price of gold. Well, I just want to remind you that you can listen to that show as well as other previous episodes that you may have missed by going to jtaylormedia.com, jaytaylormedia.com. Go to the podcast page at that website, and then you can tune in to all of the previous episodes. In fact, the one that we're doing live right now will be there tomorrow afternoon that you can hear if you've missed today's show. Also, I want to let you know that the best place to go to pick up Richard Maybury's excellent newsletter is earlywarningreport.com. That's earlywarningreport.com. I would also like to welcome all of you listeners who have learned to know about this show through the iHeartRadio syndication, which has begun passing along this show to its listeners. We have guests on this show that I pick based on my desire to seek the truth about what is really happening in the markets as opposed to what the mainstream media wants you to believe is going on. So we often have controversial figures such as economist John Williams, who will be joining me in the second half of today's show. John has long insisted that given the massive debt that America has entered into, we're inevitably heading into a hyperinflation. Well, John's hyperinflationary view is most certainly at odds with the vast majority of Wall Street pundits who see the massive debt that we've created as being a reason to fear deflation, not inflation. So we will ask John how an increasingly indebted economy that decreases purchasing power can actually lead to a hyperinflation. And so I have titled today's show, How Can the U.S. Dollar Hyperinflate with So Much Debt? As I just noted, economist John Williams will be with me during the second half of today's show to discuss why he sees the growing insolvency of America as being resolved by way of hyperinflation, as opposed to a deflationary depression, which, quite frankly, we saw occur with the collapse in 2008, 2009. And in the past, John has said on this show that it will be the massive decline in the dollar that will pivot our massive debt problem into an inflationary situation. But most people feel that there is no international currency other than the dollar, and thus there is virtually no chance that the dollar will go into the dustbin of history, even though that has been the fate of all previous fiat currencies. When discussing the American debt problem, one of the key concerns of rational thinkers has for years been the off-balance sheet promises of federal government for Social Security and Medicare. Gene Epstein will join me right after the first commercial break to discuss that issue, which will also be the topic he will discuss at the Soho Forum debate in New York City on June 17th. Gene will maintain that with the existing Social Security's $3 trillion trust fund, the system cannot add to the federal deficit any further. Opposing that view will be liberal Dr. Teresa Coladucci. She's a professor at the New School in New York City. Of course, given the fact that the American empire has, since 1971, been able to print what seems like an infinite amount of money, it's kind of understandable why liberals have concluded that there is no limit to the amount of money that can be printed. And as long as the U.S. military can have its way in forcing countries around the world to use dollars, it's hard to argue against the notion that the counterfeiting policies of the United States government can't go on indefinitely. So John Williams clearly thinks that the dollar cannot last as the world's reserve currency forever because the laws of nature will one day prevail over the manipulation by governments carried out to increase their power over the common man. Well, one person who I know reveres the laws of nature is Michael Oliver, who will acknowledge that market manipulation probably does take place, but he also believes there are limits to those manipulations. So I'm really pleased to have Michael with me. once again, and especially today because I want to ask him about the dollar, which, as I just noted, is the key to John Williams' thinking about hyperinflation. Welcome, Michael, and thanks for joining me again.
Hi, Jay. Good to be back.
Always good to have you here, and it's always good to tell my listeners that they should go to olivermsa.com, olivermsa.com, to catch up with your services. Michael, just take 30 seconds or so to tell our listeners again what services you provide. There's two basic ones that I'm aware of.
Well, since '92, we've started out with institutional subscribers primarily. We covered all four major asset categories. That'd be debt market, foreign exchange, stocks, and commodities, and with a global look, not just U.S. markets. But then a year and a half ago, we started our gold, silver mining report, which is a narrowly focused report, not quite so many reports per week, usually about two, including the weekend report. And we focus on gold, silver, and the miners, like the GDX, GDXJ, miners within those ETFs as well. So it's a narrow-focused report, and it's much discounted in price. Our rates are on our website, olivermsa.com. But the broader asset category we've had since 1992, and we focus on all the major markets. They are, after all, interrelated. And so if you're narrowly focused on the stock market, you're missing something because it's getting helped and negatively treated by other market actions. So you have to look at the out your side mirror, so to speak. And speaking of which, your dollar subject this week is a big theme of ours now. In the last weekend's report, we focused on the dollar index because of the four categories, the major forex, like the euro and the dollar, which are balance each other off within the dollar index. The euro is like 57% of the dollar index. What they do has been for the last 10 months nothing. The euro has drifted lower, but ever so marginally. You have to decimalize it. And the dollar was up to 97 on a rally in August of last year. And right now we're 96.60. So it's been 10 going on 11 months of weightlifting by the dollar. The tone has felt good. And so people who vibe off of the tone of the market day to day, week to week, and so forth, they've been lulled into this dollar strength scenario because the dollar refuses to break down and it inches higher here and there and then it gives it back up, but stays up, so to speak. So it's the quiet one. You know the story of the mass shooter. He's always the quiet one. Okay.
Yeah.
Well, these four markets, the T-bond market, T-notes are strong, if not violent, on the upside. The stock market is volatile. Everybody's focused on every swing. Gold has had quite a bit of recent violence to the upside. In fact, the biggest 8-day gain in gold in the last several years, from the 1280s to 1340 in 8 trading days straight up, which was not a surprise to us. So there's a lot of volatility in those big categories. But in the dollar index, it's asleep. And we think it's the one that's about to topple a lot of other markets as well, cause movement in other markets. We think it'll be negative for stocks. We think it'll help retard the bond advance to some extent. Why? Foreign investors have plowed into U.S. government debt because it yields something, right? Other debt markets don't yield anything. Japan, Europe. So if you want to park your money and get some yield, you come to the U.S. But if the dollar starts to hurt you, then that goes against your position. You might still get lower yield, but you're giving away the principal. Now, the U.S. stock market has been a favorite of foreign investors for a good while, at least a year, because the European indexes are anemic. Japan is definitely weak compared to the U.S. We're the place to be. So you talk about a crowded boat. There's one. U.S. stock market's loaded with foreign investors and domestic investors. But if the dollar weakens, and frankly, it's our view that the recent dollar pullback, about 190 points, 1.9 points since the high of 2 weeks ago. If you drop a little bit further, and we're very specific in our weekend report, we think it could drop 10% between now and the end of the year. And for the dollar, that's a massive move. For the stock market, that's not a big deal, but for the dollar, that's earthquake-type move. And I think it will shock a lot of people because the tone and the belief structure out there is dollar strong. And if that gets shattered, it upsets the underpinnings of many investments, like in T-bonds or especially the stock market. And we think, of course, that would boost gold, which, by the way, has not been held back by the firm dollar. Since last August, gold has gained a tremendous almost $200, $180 off last August low. whereas gold, the dollar has not assisted it.
Yeah.
Imagine if the dollar now assists gold.
Yeah.
That would be anyway. So
yeah, it should be very bullish for the gold shares. I would think gold and silver as well. Maybe silver even more so, eh?
I think so too. Yep.
Yeah.
So you can watch gold, watch the S&P, watch the bonds, and try to do your measurements and so forth. But right now we say watch the dollar index because that's where the ambush is going to take place.
Oh, I mean that fits very well with the ideas John Williams has longer term anyway. That the main reason, the main stimulus for hyperinflation will come from the weaker dollar, because if you look at the debt is growing so exponentially, it's robbing the people of purchasing power. So the demand side of the economy is shrinking to a great extent, notwithstanding all of the hoopla that the Trump administration is giving us about the wonderful economy. I don't really quite buy that. Do you?
No, nor do I.
I mean, every president tries to. Obama did the same thing. Tried to claim that he had such a wonderful economy. It's all a lot of BS, I think. But in any event, so Michael, just with a minute left or so here, what we've seen here essentially is a decoupling. It seems to me. I mean, normally when you have a strong stock market, you have a weak bond market as interest rates rise. But here we're seeing a strong bond market and a strong stock market. Interest rates declining, which, is the bond market trying to tell us something, that the economy isn't what it's all cracked up to be?
I think we also looked within the S&P this last week, for example, the sharp rally from the low of 2 weeks ago. And if you do the measurements properly, the S&P last week from the low of the week to the high of last week's rally was up 5-something%. Nice move. NASDAQ 100, the former leadership index, was up over 4%. Not as strong as the S&P. Meanwhile, you go out and look at utilities sector and consumer staples, the people that make toilet paper and soaps and stuff like that.
The things you have to have.
Defensive stocks, up 6%. So what's going on here? How come the investors who are plowing back into the stock market, praising the upticks, how come they're going into the defensive sectors and not back into tech to the same extent?
Right. Yeah,
and how come they're still buying T-bonds, and how come, et cetera, et cetera? How come gold exploded? So there's too many flags out there waving that aren't cheering the stock market on. They're internal warnings, external warnings, and we think when the dollar hits, the warnings will get loud.
Right. That could very well be. Michael, thank you so much for your time again today and for sharing your wisdom with our listeners. Always appreciated and always highly valued, I'm sure, by our listeners. So thanks so much.